Hi everyone, good to see you. Happy New Year of the Rabbit. Hope this year will turn out to be a lot less eventful than last year and a smoother sailing for the market. So today I will share my updated macro view for 2023 and 2024 for China and how it might affect the rest of the world. We all know that at the beginning of the year, economists, strategists attempt to make forecasts, while some of them might turn out to be right. But there are a lot of the pitfalls that could happen along the way. And usually the path to realization is a lot bumpier than a lot of people anticipated, especially for 2022. A lot of things that could have gone wrong for China and the rest of the world has gone wrong. It's been a very trying year. We're looking at 2023 and 2024 with a little more optimism. And today I'll share why. So from a very high level, macro perspective, 2022 in terms of capital market challenges was mainly threefold. Of course, every fold of them can turn into many smaller issues, but mainly threefold. Number one is a very rapid pace and a lot of uncertainties around the pace and endpoint and impact and the intention of the US and the G10 central bank rate hikes. It accelerated throughout the year, and the market was not sure when it's going to end. Is it going to be effective? And where is the optimal interest rate level, the real interest rate, as well as the nominal interest rate level? So that created a lot of volatility in terms of market sentiment and the valuation. What kind of valuation is a proper valuation for growth stocks, or even for the whole market, or even for equity market as a whole? There is a lot of fund flow out of it, especially the higher growth sectors and the alternative investment sectors that have accumulated a lot of inflow and gains. That's number one, a very big uncertainty last year. The second one is the broader global geopolitical risks that I think a lot of things came out of left field, and the butterfly effect or the multiplication effect festered throughout the year. We've seen, pockets of pains here and there, and a very painful March, and a very eventful summer, and a pretty eventful autumn as well. And all these geopolitical risks and the interplay between, of course, a lot of things happened around Russia, Ukraine, and what it did for global geopolitical landscape and energy market. And secondary to that, China-US relationship seems to have been, going through a rougher patch as well. And the uncertainties around that, and more specifically, for example, for overseas listed Chinese stocks, has induced huge volatilities for the market, and at certain periods of time, at extreme times, has induced I think some kind of existential questions about investment in China as well. So that was really pretty difficult to quantify last year. The third macro risk or uncertainty investors had to endure last year was China's economic fundamentals. It was fair to say that throughout most of the year, people kept downgrading their growth forecast for China. If you look at Bloomberg consensus, if you look at the street forecast, there's been a wave of downgrade around March to May, and then another wave of downgrade between July and October, and a very rapid chase to the bottom in November. So basically, data in China, although there's been periods of stabilization, but throughout the year, it's been revised down throughout the year, and the expectation has gone down with the reality. So three major, headwinds for investment in 2022: rate hikes, a lot of uncertainties around that, geopolitical risk rose exponentially, and China's data point points to weaker fundamentals almost every quarter. Things could have gone wrong, especially for Chinese equities. A lot of things that could have gone wrong have already gone wrong. Looking into this year, we feel a lot better because out of the three, for number one, we're seeing the light at the end of the tunnel in terms of where terminal rates might be, and we're seeing lights at the end of the tunnel in terms of effectiveness of monetary tightening over inflationary impulse, at least for now. I'll expand a little bit on that later when we talk about the potential second round effect from China's reopening to the rest of the world. That's number one. And number two, geopolitical risk. Of course, there's been, frictions here and there, but I think the higher probability of outcome for this year is a much less turmoil around geopolitical relationships this year, or less uncertainties, especially regarding China-US. We're not looking for a fundamental turnaround, but I think the uncertainties should have been reduced this year. And the third thing, which is most important, and we will spend most time talking about today, is China's own economic fundamentals and what the data point is going to show. The data point is going to show improved economic fundamentals, and market expectations should, over time, catch up with that. That's our view. So I'll dive into that in the rest of my presentation, and at the end of it, I'll wrap it up with some potential second round effect and some risks. This is a 40-page presentation, but I'll spend most of my time talking about maybe only 3 or 4 of them. So please bear with me when I flip through the pages. First of all, this table is our master table for all the macro indicator forecasts for China. I'm not going to go through all of them. They're really small prints. I'll just go through some of the key graphs. Number one, our expectation for growth this year. So basically, we upgraded our real GDP forecast again right after Chinese New Year, the first trading day after Chinese New Year. For 2023, we now expect real GDP growth to hit 6.2% for China, up from 5.8%, which was our previous forecast in November. And as you can see from the left-hand chart, first of all, the street consensus now stands at 5.1%, 1.1 percentage point lower than our forecast. And you can see the trajectory of the market consensus taking a dip in early 2023 and revising up very quickly. It revised up by 30 bips in just the 3 weeks after the beginning of January. That's very interesting. What happened? What happened is China's consumption number coming out of Chinese New Year seems to have improved much faster than a lot of people anticipated. So our forecast stands firmly above consensus. And more interestingly, we also rolled out our 2024 GDP forecast. It stands at 5.8 for 2024. So that puts the 2-year combined GDP forecast at 6.0. Is that too aggressive? I would like to say, considering the base effect from last year, I do not see our 2023 and 2024 forecast overly aggressive. Number one, if you look at 2022 and 23 combined, we're only looking at 4.6 percentage point of growth. And if we're looking at 2020 to 2024, the 4-year period, we're only looking at 4.8%. However, the 4 years preceding that, which is 2016 to 2019, we were looking at 6.6% compounded growth for the 4-year period. Thus, potential growth can get revised down by more than 2 percentage points over such a short period of time. That was very rare, barring huge political upheaval and stuff like that, especially for smaller countries. For a large country like China, it doesn't really happen very often in history. So in that sense, if you look at how low the base effect has been, our number isn't all that aggressive. However, if you stand, in front of the trajectory that we're mapping for the next 8 quarters, today, if you look at it today, it does, look a bit optimistic from a few point of views. Number one, if you look at the right-hand side chart, for first quarter this year, we're looking at 3.6% growth, which isn't too high, too impressive, because number one, we're still basically climbing this, ladder of capacity utilization. At the start of the year, the capacity utilization in production as well as consumption was still at very low starting points. Even if we restore to close to full capacity by end of first quarter, the average is still going to be much lower than usual. So it says, below trend capacity utilization rate for the first quarter. So we're looking at 3.6%. And last year for the first quarter, the base was the highest of all the quarters at 4.8%. There was still I think there were also chatters about how the January-February data for 2022 was inflated. So long story short, the first quarter data isn't all that impressive. However, if you look at if you stand at the end of the first quarter and look into the next 4 quarters, the number look a lot better. So the next 4 quarters, we might see real GDP growth all above 6%. For the rest of 2023, we're looking at 2Q to 4Q at 7.5, 6.3, and 7.0. A lot of it was driven by base effect, but it also reflects a rapid restoration of capacity utilization in the first half of the year. And the juiciest part of the recovery should happen in the first quarter of the year. And secondly, I'd like to remind everyone of basically the elasticity of growth and what does that mean for corporate earnings. That answers a lot of questions about the market, whether we have already priced in a pretty, optimistic outlook, or do we still have room to be pleasantly surprised. So what does it mean for real GDP to go from 3% last year to 6.2 this year? So there are, I think, many layers or many amplification effects that we need to take into account as we go from, say, real GDP growth to corporate earnings. So number one is China's real GDP growth at a turning point. Growth and inflation usually moves together, while corporate profit is more sensitive or more correlated with nominal growth rather than real growth. So last year, we're looking at nominal growth at 5%. And this year, we're looking at real growth going from 3 to 6.2, and inflation might be higher this year as well, both in terms of CPI and PPI, especially in the second half, because inflation lags growth by a quarter or two. So in that sense, we're looking at nominal growth at 8.8% this year and 8.6% for 2024. A big step up from 5% in 2022. But that's only the first amplification effect I was talking about. The second one is exchange rate. So from China's economic fundamental point of view, if you look at the right-hand side chart, so when growth fundamentals improve, exchange rate usually reflects the growth differential change between China and the US, for example, if we're talking about RMB versus US dollar. So growth, inflation, and exchange rate usually moves in tandem. So in US dollar terms, the improvement will be much more impressive. We expect RMB to appreciate to 6.42 at the end of this year versus the US dollar, and 6.32 at end of 2004 versus the US dollar. What does that mean? First of all, that only means RMB restored its value or its level back to March last year, right before the breakout of the Shanghai pandemic. In that sense, I think from a mean reversion point of view, it's not overly aggressive. But what does that mean for nominal growth in US dollar terms or for overseas investors when they look at Chinese companies and their earnings? So nominal growth in US dollar terms, if RMB were to appreciate to the level we have forecasted, would have gone up to 13 to 14% in 2023 from 2% in 2022. And what's more impressive is the quarter, like last quarter last year to this last quarter this year. The jump would have gone from -4% to a positive 20%. That would be a pretty impressive upturn. Be reminded that the RMB bottomed at around 7.36 at fourth quarter of 2022, and since then has already appreciated 8 to 9%. And the corporate earnings should reflect that. However, if you look at the left-hand side chart, from a macro level, what's even more impressive might be the third amplification effect I'm going to talk about, which is nominal growth to corporate earnings. So we see a 3 to 5 times elasticity, the translation from a 1 percentage point increase in nominal GDP growth to corporate earnings growth. So if you consider that, we will probably see nominal GDP growth at 8.8% this year and corporate profit growth potentially at the range between 15 to 30% year on year in RMB terms, and even much higher in US dollar terms. And this year, if you look at overseas listed Chinese companies translated into US dollar earnings, we could see a pretty impressive jump, even higher than what we are talking about here for RMB-based earning growth at, the medium in the past. If we see almost close to 9% nominal GDP growth, the medium was at around 20% year-on-year RMB termed corporate earnings growth. But in US dollar term, if RMB were to appreciate to 6.42 as we forecasted by end of this year, it could jump by even much higher than that, especially for the second half of the year. While if earning growth will to be realized at the second half of the year, expectations should be adjusted up in the first half of the year. That's why we picked the timing as right before the first quarter earnings, but right after the Chinese New Year holiday to upgrade our GDP forecast. So that's number one. On the macro level, what does the main numbers mean? Number two is, where is our expectation gap versus ourselves previously? Why did we upgrade from 5.8 to 6.2? And second is, where is the expectation gap or perception gap between us and the rest of the street? Why do we see growth much higher? Why did we upgrade from 5.8 to 6.2? Two main reasons, one technical and one incremental. The first reason for the upgrade was the technical change in terms of the base. Basically, fourth quarter GDP from last year turned out to be much better than we expected. We expected 1.5 to 2 percentage point real GDP growth in fourth quarter of 2022, and the number came out at 2.9% year over year. And for macro forecasters, we all know that if you raise the base for the fourth quarter of last year, the numbers for this year will change accordingly. However, some investor might question, what about, what if you have to give back to whatever surprised you on the upside in fourth quarter of 2022? We look at the numbers. The main surprise came from December retail sales data. It came out much stronger than high-frequency trackers would indicate. However, what surprised on the upside was mainly value added from Medicare and medical services. In that sense, a lot of it was, yes, it could be one-off, but first of all, the numbers, Medicare expenditure grew by 33% in December last year. The number is hard to be refuted. It looks to be real. Secondly, I think some of it also extended into the first quarter of this year. So considering that, we don't think it's something that would necessarily be completely reversed in 2023. That's the first technical issue. The second issue is how fast China has gone through the peak of the so-called infectious period of Omicron. So China adjusted its pandemic control policies, I think signified by the Guangzhou policy adjustment on November 30th, 2022. And at the time, we expected that even with a very high R0 infectious rate and a pretty densely populated, geographical layout, we were thinking, demographic layout, we were thinking that it would take, according to other countries' experience, even adding some China speed, it would take at least 6 weeks for 60 to 70% of the population to be infected. But it seems like it happened sooner. The infectious rate or the implied infection rate might have gone up pretty quickly, and the peak might have been passed in just 1 month's time. So that also, save us some downtime in the first quarter of 2023. What that means was basically we were in our previous forecast expecting China's consumption in terms of, for example, volume of tourists to recover to about 90% of 2019 level by Qingming Festival, which is April 1st, around the beginning of April, first weekend of April. However, by Spring Festival, as you can see in this chart, it has also already recovered to almost 90%. And what's most impressive is not even this 90%, it's the slope from the 40% to the near 90% just in 20 days, from New Year to Spring Festival 2023. Be reminded that Spring Festival falls on January 21st, 2023, just in 3 weeks' time. So that is truly impressive. Even after the 2020 lockdown, we did not witness a slope quite as this steep. So in that sense, we need to bring forward our time schedule for consumption recovery. And that's what we did. So we basically make up for some time here. That's why I upgraded our GDP forecast and where the gap was between now versus 2 months ago in our old forecast. And more interesting to the market is number two, how we differ from the rest of the market in terms of China's growth outlook in 2023. What's the main differences? I would say if you look at sectorial driver, the main differences are number one, consumption recovery, and number two, property sector outlook. If you break down the big numbers, the big chunks of numbers for 2023, we're looking at consumption growth at nominal retail sales growth at 10.5% year on year, taking out inflation, consumption growth between 7 to 8% in 2023, contributing to, compare with 0% last year, official number, contributing to about 3 to 4 percentage point increase, 3 to 4 percentage point increase in real GDP growth this year. And on the property side, we're expecting a bunch of zeros, which is a big improvement from last year. We're expecting sales volume growth to be pretty much flat, slightly up from last year. We're expecting investment growth to be, for the whole year, about 0 and negative in the first half and positive in the second half. But this number already will reduce the drag from property investment and consumption and so on in transaction to growth from negative 2% plus last year to 0 this year, which means from property, we gain another more than 2 percentage points. And the main subtraction will come from net exports. We expect net exports to contribute around 1.5 percentage point less to growth this year. So all added up, we are seeing more than 3 percentage point jump in aggregate, growth versus aggregate value added from last year. So you can see the biggest contributor is number 1, consumption, and number 2, property, which is basically less drag. And the biggest perception gap between us and the market, especially us and overseas investors, lies in number 1, the strength and the sustainability of consumption recovery, and number 2, whether China's property investment and consumption can recover. For number 1, after the Spring Festival data and some early data from Chinese tourists, say in Macau, Hong Kong, rest of the world, be reminded that there's a big bottleneck in terms of overseas traveling at this point. But even so, we have seen big upside surprises already as China just reopened. The speed surprised a lot of people. So in that sense, I think the expectation gap on consumption has been narrowing, but I think a lot of investors still don't grasp the whole picture as at least they're not as optimistic as we are. Number 1, technically, I think a lot of Chinese tourists still have not been able to renew their visa or renew their passport, get the visa and get the entry-exit permit for Hong Kong and so on. Just look at the numbers in terms of tours, overseas tours booked versus overseas tours realized over Chinese New Year. So overseas tours booked is 6.4 times higher than same period, Spring Festival 2022 this year. However, number of visitors overseas only grew by 1.2 times, which means most people are still stuck. They still haven't been able to make their trip, although they booked their trip. And the number continues to grow. There's a big backlog in terms of visa application, flight ticket sourcing, and all that back in mainland. So a lot of them are still coming out. The expectation gap is closing. But from a macro point of view, from my marketing, I think it's very important just to talk about one thing in terms of why we are so optimistic on consumption growth versus the market consensus. So this year, we hear a lot of people's forecasts putting consumption at 7 to 8% in nominal terms, which means retail sales growth at forecast at 7 to 8% for the whole of 2023. We find that a bit inconsistent with their real GDP forecast, because most people at this point, especially the domestic brokers or the Hong Kong brokers, they put it total GDP forecast for 2023 at about 5% year-on-year. And that means nominal growth at above 7% year-on-year. So that means their retail sales growth forecast is about the same as their total growth forecast. From a macro perspective, total value added or total GDP equals total income for the country. So that means they put consumption growth the same as income growth. But coming out of the pandemic, it just doesn't seem likely for China, or it has never happened for any of the other countries, because propensity to consume will recover. There were a lot of fiscal constraints over consumption in 2020 to 2022, especially in the first half of 2020, in the second quarter of 2022, and worse yet, in the fourth quarter of 2022. How much has it impacted the consumption propensity? What is consumption propensity? That is how much money you decide to consume versus save out of every dollar of disposable income. For the average Chinese household, they usually consume about 70% of it before the pandemic, as shown in the in the left-hand side chart. And they save the other or invest the other 30 cents. Be reminded that that 30 cents includes property purchase. So there are a lot of questions on why would you expect property investment or consumption to be strong? Why would they still have money left for consumption? That's a misplaced question as well. Just a side note. Back to propensity of consume. What happened in 2020 to 2022? So if you look at the left-hand side chart, people spend a lot less during lockdowns. That's common sense. So when they get out of the lockdown, they will spend a bigger portion of what they used to or what they did during the lockdown on consumption. That is why retail sales growth grew back to 12.5% in 2021. So in the first half of 2020, it dipped to 75%, as in people spent 65 cents instead of 70 cents before the pandemic on consumption. And it went back a bit in 2021, but during the Shanghai lockdown, it declined to 66% in the second quarter, for the whole second quarter of 2022, and it declined to 64%, the lowest yet, in fourth quarter of 2022. However, from other countries' experience, after reopening, propensity to consume all come back. In the sense of US, it came back to higher than what it was, which means people start to save, people start to deplete their savings. A lot of the question about China consumption has been revolving around whether Chinese will start to dip into their excess savings. I think that is talking about the smaller determinator of consumption while ignoring the bigger factor. The bigger factor is how much income is going to be growing and how much of income people are going to allocate to consumption. Because excess savings, according to our estimate, which is in the pack, I won't spend time to find that chart for you, but it stands at about 3.6 trillion RMB. A big chunk of excess savings for sure. That's about 3% of GDP and 6 to 8% of retail sales. However, that is very small compared to how much income is and how much income growth can swing and how much of a change of allocation of income to consumption can swing consumption growth. So even without dipping into the excess saving, which means even without assuming propensity to consume will recover to pre-pandemic level at 70%, even without assuming that, we will see propensity to consume increase after reopening. And that means every percentage point increase, consumption should grow faster than income, and it should grow faster than GDP. So we believe the market outperformance in the consumer-related sectors is more than justified. However, what is the elasticity here? So if we look at propensity to consume to normalize at 70%, consumption growth should stand, or retail sales growth from nominal terms, should stand at 12%. If it goes back to 68%, propensity to consumption, and that means we only recover half of our will to consume, which means excess saving will continue to grow. Even ignoring all that, consumption growth could still be close to 10% in terms of nominal value. So now you see why when I talk about our retail sales forecast of 10.5%, I'm pretty confident, because I think a lot of people, when they're looking at excess savings and how it might go, or even if it will or will not be depleted, I think that's pretty much besides the point. As long as people's consumption propensity normalize, or even just partially normalize, we are going to see much higher retail sales growth versus last year and versus nominal GDP. And that could mean it could easily surpass 10% year on year. So that is now number one difference versus market consumption. So while market consensus has been catching up to our forecast, we do still think there's room to go. Be reminded that after 3 years of down cycle for consumption, especially certain sectors, for example, catering or dining out consumption in China is now 40% lower than its potential level. 40. So it's only, if it goes back to 100, if it declines by 40, it needs to grow by almost 70 to go back to 100, not counting any, continuing expansion of the trend in 2023. So there are sectors, as you can imagine, with a lot of capacity withdrawal. So this year, we are packed with sectors with huge operating leverage. A lot of people do see somewhat of recovery of the top line, but when you talk to the companies or when you really investigate these industries, the low margin industries would have had a lot of exits. The cash flow dependent industries would have definitely had a lot of exits. So the capacity side is much more consolidated and much tighter. The operating leverage could surprise you to the upside. That's one thing I want to say. And of course, e-commerce, online consumption in general is also part of consumption. And housing-related consumption, renovation, furniture, home appliance is, of course, also part of consumption. These are the sectors we are quite upbeat about in terms of earning upside. So that's the number one difference versus the market. Number two is on property. I think although the market view is catching up to our consumption outlook, there's still pretty downbeat on property. Part of the reason is we haven't seen numbers for first-hand property transaction come back in a decisive manner. So for that, we're still in a sort of a data watching period. And how it's going to come out is going to determine how much more market expectations can be revised up and how much broader consumption recovery can go. So this is a very important and increasingly important point of debate. Our view is that while we're watching the data very closely, our view is that it's more likely than not that property consumption starts to come back, or property transactions start to come back. A lot of people say that property developers will have very little incentive to expand their balance sheet this year. So land transaction will continue to be poor and investment will continue to be low. So our investment forecast stands at 0% year on year with higher completion this year, but lower new starts. However, that I think is pretty much driven by the trajectory of transactions. So we need to figure that out first. We're a little more optimistic than market consensus because if you look at last year, if we forecast 0% year-on-year growth of the volume, that's basically saying from a sequential basis, we need to grow 20 to 30% from fourth quarter of 2022. Because fourth quarter of 2022 was last year, it was basically gap down in second quarter and then gap down again towards the end of the third quarter. So the base goes lower. And this year, if we want to see a flat year-on-year number, we need to see a pull up from first quarter onwards. And that is what we are forecasting. How bad was it last year? So after seasonal adjustment, quarterly transaction volume, when annualized, maps to less than 1.2 billion square meter annualized for fourth quarter last year. That is down more than 40% from the recent peak in fourth quarter of 2020, which is close to 2.1 billion square meters. So just in a matter of 2 years, it declined by almost half. That's pretty dramatic. So this year, can we recover? Will we recover? I think if you consider economic fundamentals, it should. But if you look at number, it might lag. First of all, why would it lag? Because there's usually a lot of momentum built into expectation of housing prices. Back in 2008, 2009 stimulus cycle, the 4 trillion project, the 4 trillion stimulus started to hit the market in November 2028. You see a lot of early cyclical indicators start to have a V-shaped rebound after massive rate cuts by the Fed and the 4 trillion. At the time, M2 growth was jumping like 2 to 3 percentage points every month. And at the time, compared to a much smaller base of loan number back then, new loans was more than 1 trillion every month. That's pretty much equivalent to new loans being more than 3 to 4 trillion every month. So that was a really big stimulus. It started to hit macro, started to lift early cyclical indicators by November of 2008. But property market did not bottom until March to April of 2009. There was a lag. Same happened to 2015 and 2016 stimulus. The lag was mainly because of, it takes a little bit for expectation to adjust because there's so much momentum built into housing price expectation. And a smaller issue was the seasonality of basically a pretty quiet market around Chinese New Year. So this year, what will it be? So so we are a little more upbeat than the market, and the reason is threefold. Number one, from a asset price valuation point of view, we are looking at a better cash flow potential for properties, as in rental income expectation, together with nominal income expectation for the whole economy should be adjusted up. That is the numerator. That is the numerator. That is the numerator. And the denominator, which is mortgage rate, the discount rate, has been cut by more than 200 bips last year. It's pretty aggressive. A lot of cities now have a 3 handle on mortgage rates. And that stands in stark contrast for the rest of the world, where mortgage rate has gone up, for example, from 3 to 7% in UK, 3 to more than 6% in the US. So this is actually quite effective. But last year, in stimulating demand in the past, last year, we've seen the rate cuts, but physically it's been hard to get property. And the expectation was very uncertain. So from asset value, expectation point of view, if you look at the discounted cash flow or the rental income, basically we're seeing the increase in the numerator and the decrease in the denominator. It's very hard for me to continue to believe that people's expectation for property price will continue to worsen incrementally. Yes, there are concerns, but the concerns are not new concerns, be it demographic, if we have an hour, I'll talk to you more about where are the pitfalls in, these type of a simple analysis in terms of demographic, like square meter per capita and so on, but we don't have time today. So let's talk about incremental. It's hard to refute the fact that incrementally, these asset price indicator points to recovery in price expectation. So that's number one. Number two is, what is China's, people call it gangshu or inelastic demand. I think a lot of things that could have gone wrong for China property demand have gone wrong together and in a dramatic way, in an extraordinary way in fourth quarter of 2022. I tend to think that might be a periodical bottom. But does data support that? Long story short, China has, according to the 7th census, China has a total stock of 520 billion square meter of residential, sorry, not 520, 52 billion of residential property stock. And if you basically do an amortization rate of 2%, which means the property in such good quality that it amortizes over a long period as 50 years, which is only seen in highly developed countries and very slow growing countries, very slow growing. China fits neither of those criteria, but let's use the most conservative measure. That means 1 billion square meter needs to be torn down every year and rebuilt. Even if we use a 40-year amortization period, which is still pretty generous considering the quality of Chinese, newly developed properties, that will leave us a bottom replacement need of 1.3 billion square meter. That is not including a few things. Number one, China's trend GDP growth or trend income growth, which is nominal, is about 7 to 8% still, which means per capita GDP doubles less than every decade. That means what people want in their property will change dramatically versus a more developed country. So that means more upgrade needs. And from an urbanization point of view, China still only stands at 47% of urbanization if you talk about household registration or hukou, and only 65% if you talk about basically where people live. But in that sense, a lot of them are county level cities. They're not real metropolitan cities. Long story short, still more than 10 million people needs to be urbanized every year in real sense. In that sense, we cannot compare apple to oranges. We cannot say you do have a house in your hometown, so you cannot want another house in the urban area where there's real job opportunities, healthcare, and education facilities. And number three, if you look at the current stock of Chinese housing, residential housing, according to the seventh census in 2020, 60% of them does not have elevator. It doesn't bode well for Asian population, does it? And 9% of them don't have their standalone bathrooms, and 4% of them don't have a kitchen. All these are still upgrade needs, compounded with higher income growth. I don't know why that shouldn't help everyone. Still wants to, I think people, if we're still doubling our income every 10 years, people will want a more modernized life. So there's still a lot of structural demand from that. And I would like to remind people too that although a lot of people talk about stagnant population growth as a whole, if you look at Asian countries, you can see a very rapidly declining trend of average number of people per household. There is, kids starting to live alone after they become adults. There is more smaller family in terms of less children or no children wanted by the couple. And there are more people who choose to be single. So average family size declined from 4.4 to 2.6 person per household from the 1980s to 2020. And in the past 10 years, it declined by 0.5 people per household. It declined from 3.1 person per household to 2.6. What does that mean? That means 7.2 million new households are being formed every year. A lot of it was splitting from the old households. So even with very slow demographics, like population growth, we could still have housing demand coming out of splitting family sizes. So in that sense, I think this is a lot of things people neglected. Long story short, we do think 1.2 billion square meter per year is probably the periodical bottom, much higher than market consensus will point to. It's number two. And number three is early signs of housing transaction recovery. So we do see that secondary market transaction being a leading indicator for the primary market transaction, and that has warmed up a lot. So Huatai Research tracked the daily secondary market transaction for the largest cities in China. We sample a few dozen cities every day. And from that data, we do see a very significant increase year on year. But, in China, I think a lot of needs are driven by upgrade needs. So secondary market consumption, people has to sell their old house to buy a new one. That could be a good leading indicator for the primary market consumption. So we continue to watch that very closely as well going into the rest of the year. We do think that if historical pattern dictates, we should see a recovery of property demand around the end of the first quarter of 2023. So we'll continue to see that, but that's the big expectation gap between our forecast and the market, and one of the most important determining factors of whether market upgrade of Chinese growth this year and earning growth this year could continue. So that's the main part of the presentation, which I talk about why we upgraded and how we are different from the market. And lastly, I'd like to talk a little bit about what does China reopening mean for the rest of the world. So China is responsible for about 1/3 of global manufacturing value add. China demand coming back online obviously is helpful for the global industrial cycle. We're seeing early signs of the global inventory destocking cycle coming to an end, maybe in first quarter of 2023, at least for a periodical end. Some of the sectors movement already reflected that. It reflected an expectation of a continuing worsening of the cycle to a potential stabilization of the cycle in the more sensitive sectors, such as semiconductors, handsets, auto parts, and so on. And we're seeing China reopening being helpful to stabilizing global merchandise trade cycle. So we do see export growth to bottom in the first half of the year. That's the first thing. And the second thing is on inflation. However, growth does not come without the price of inflation. That is an economic rule. So in that sense, we do think inflation in China could start to pick up in the second half of the year. And for China, it's still, all considered pretty healthy, because China does have excess capacity in manufacturing from, declining exports this year. And China has an army of excess laborers, rural labor that migrates to the city for work amounts to 300 million as of 2020. So that's a big fleet of labor that could be flexibly employed. However, inflation is a signal for capacity expansion. We do need to see some signs of inflation slash reflation for companies to want to invest again, for workers to want to come back, for them to make the initial move. So we do see inflation recovering in the second half of the year, especially considering very low base for non-food CPI in second half of 2020. However, what does that mean for the rest of the world? Less slack coming out of China. Be reminded that China's deflationary impulse, be it on oil demand or on merchandise goods in general, has been one of the factors helping global inflation to peak at where they were in fourth quarter of last year. While China comes back online, just from an oil perspective, in 2021, China's average daily oil consumption stands at above 15 million barrels per day. And in 2022, in the first 11 months, it was below 14 million barrels a day. And let alone the impact, I think everybody knows from firsthand effect, the Chinese tourists and the rest of the world. Just overall speaking, a smaller output gap, or potentially at some point a positive output gap on China, might not be helpful for the global battle against sticky inflation. That could be something, as a source of market volatility going into 2023 as well, especially into later parts of China recovery. I like to use the analogy as, for China, a little bit of reflation is welcome because, you give a piece of chocolate to someone starving, it's much better than, not having food. However, for the rest of the world, they might need to reduce a bit of their calorie intake, and that could be a problem. That's why on a relative basis, we do favor RMB-denominated assets on a relative performance basis versus the rest of the world. Although this year will not be smooth sailing, and it might not present a fierce rebound with little break as we saw in 2029, because the reality is China will not put on as much leverage as it did in 2009 from a relative basis, and policy will be more balanced in terms of supporting growth, but also not creating longer term issues for the financial stability. So in that sense, we will not see a 2009 style rebound. However, it could be a more sustainable one. But another source of volatility is also the lack of coordination between the major governments, especially between the G2, China and the US. So that could be also source of volatility in 2023. However, we do think, back to my opening remarks, we do think that this year, the uncertainty stemming from geopolitical tension should be much less than last year on a comparative basis. So this marks the end of my presentation today. Hope that was helpful for our investors, and please contact your respective salespeople or our team or myself if you have further questions or feedback. Happy to discuss, and happy investing. Thank you.